So we continue with our charts. I think we have, I don't know, about a dozen left. Then I have a few updates. And then probably next time we'll try to do some more real-time charts before we move on to macro analysis. So what you see here is, I don't know, roughly 15-year, a 15-year chart of the US dollar index. US dollar index means that it is a basket of other currencies. In other words, the value of the US dollar as measured against the value of a basket of other currencies. Euro, yen, British pound, etc. So, one of the most important things to see is the value 80. 80 is or has been the long-term, or probably let's call it the all-time support of the dollar. So 80 has held, I'm not sure, probably about 30 years or so, close to 40 years. And 80 has been the rock bottom. 80 has proven many decades over and over again that whenever it goes down to 80, it bounces off as a super solid support. So, falling below 80 is considered from a technical point of view catastrophic from the dollar. It is considered the beginning of the end for the dollar from a purely technical point of view. Now, just because it's considered to be the beginning of the end for the dollar doesn't mean the dollar disappears, doesn't mean it vanishes its value to zero. It means that maybe for 5, 10, 15 years, you're going to be entering a real secular bear market, so that, let's say, 10 years from now, it may have fallen 5 or maybe 10 times in value, and it will have probably lost its global monetary significance. So, first of all, what you see here is on the way up, you have a nice, beautifully formed trend channel. You also see there is a nice, beautifully formed trend channel on the way down. The multi-trillion-dollar question is, will 8 hold or break below 80? That's the concern of every technical analyst. You see, first leg down correction. This should look like Bulgarian Stock Exchange over the last couple of months. Major leg down correction. A third leg down, significant correction. Fourth leg down, lengthier connection. Leg down, even lengthier connection. Now, here the key part is, okay, is it going to go up or is it just going to fall off the cliff, meaning below 80? Well, we'll probably find out soon, if not next time when we get it in real time. Let's move on to the next chart. Alright, so what we have here is similar stuff. Now we're zooming in. Back then was what, 15, 17 years. Now we got roughly a year and a half, 18 months. You see a very nice, this is called a falling wedge. This type of a falling wedge is a classical example of a reversal pattern. So once it has been doing this for roughly 14, 16 months or so, from end of 2005 to roughly mid-2007, you would expect in that type of environment, so this is kind of like triangle but going down, you would expect a major reversal, a recovery, and the dollar to be recovering for a while. In other words, this is a cyclical move on the way down, a long-term move on the way down. You would expect an intermediate correction. And then, if your secular hypothesis bear market is correct, after the intermediate correction ends, you would expect the cyclical, or sometimes called the primary, to continue on the way down. So this is here the hypothesis. Of course, may turn out to be true or false, but that's what one would think should do at this point in time. Let's click further. Alright, so this is US dollar history. And you see from 71 the dollar, let's see against what? I think it's just real dollar USDX. I'm not so sure what is this relative to. In terms of a real dollar, I'm not so sure what is this. But you see how this guy has done it, critical, historical. Sorry guys, I can't tell you. Let's move on next. I forgot what this was. Alright, this is XAU. This is gold and silver index. This is an index of mining stocks, and there are two types of indices of mining stocks. Mining stocks are either hedged or unhedged. So a mining company, when it expects to produce a year, 2 or 5 years down the road certain quantity of gold, it may not hedge it. Means that if the price of gold goes up significantly, it will profit from it. However, if it hedges it, this means that in the expectation 12 months from now to mine, let's say 1 million ounces, it will hedge it by selling today short on the futures exchange at 12 months futures for that quantity. So 12 months out, if the price have gone up, they will not benefit from the move of the gold price up. But if the price goes down, they will have hedged and will not sustain the losses. In other words, when you hedge 12 months from now, if there are gains, you don't stand to benefit from it. But if there are losses, you don't stand to lose from it. So, the tricky part to understand is that in a bull market, gold boom or any commodity bull market, the preference is for unhedged stocks, as the unhedged stocks can truly benefit from the bull market. And if they are hedged, whoever has hedged against them on the other side, in other words, they sold short. Someone bought the long contract. The long contract will, whoever that was, will extract the profit from the bull market. So what you would expect is that hedged miners, gold and silver miners, should underperform unhedged. Well, this one at least just shows you, okay, here's one, here's another trend line. This is how they think it goes. They say, okay, it's going to shrink, 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 and ultimately get from above or get from below, all right? And they say, okay, this trend line needs to be broken above. In other words, this is a trend line. You gotta break above, and then you could meaningfully expect it to break from above. All right. So the point is that the XAU tracks much closer the price of gold, but there is something else. If you're a gold analyst, you want to check out the price of gold stocks, because in general it is believed, and some econometrics can show and prove it, that usually stocks lead the commodity. In other words, if the commodity is about to rise, stocks will forecast it ahead of the move of the commodity itself, and the stock price will rise. Again, this is sometimes, most of the times, true. Sometimes it is not true. Depends whether you're in the first phase or in the second phase, whether in the third phase. Again, I'm not saying one outperforms the other. I'm saying one leads in time the other. So, everyone is usually expecting, and that's the general belief, that stocks will lead. So speculators like to watch the stocks. When they see the stocks break out decisively, they take long positions in gold and try to profit by speculating, highly leveraged speculation on gold. So that's the way the thinking goes. Again, no one really cares about portfolio theory in real life. That's how they speculate. That's how players work. All right, let's move on. See what's next. Okay, that's the same XAU. It is about 15 months roughly, a year and a half. Oh, sorry guys, this is 6 months only. But you see, that's the intermediate correction on the way down. That's an intermediate move on the way up. Again, that's an intermediate on the way down. You see here the lows, lower lows. you probably see lower highs. So right now, if you're in a secular bull market, this clearly looks like a primary bear market trend. In other words, this is a major multi-year correction within a 10, 15, 20-year secular bull market. At least that's the working hypothesis of those analysts. Let's move on. What is this? This is XAU. Okay, so you see here how the analyst has highlighted this as a major range for resistance. This is how he's called it. He's called this the channel bottom. In other words, every time it comes. Alright, another key word is testing. To test means that once a support has been established, or once a resistance has been established and has been valid maybe once, maybe longer, when you get to move to the same support back or to the same resistance, to test means to see whether it will penetrate and move further down, or the test will fail. So, testing it here and it failed, meaning didn't go. So, it tested here the resistance and it didn't go through. It tested a second time the resistance here and it didn't go. Then it tested a third time. So, the more tests that the respective resistance or support survives, the stronger is that support or resistance level. In that sense, we can say that for US dollar, the level 80 has been for 3 or 4 decades valid. It has been tested many times, so it is phenomenally significant. 3-4 decades, 30-40 years, phenomenal significance. Every time it's been tested, it has held. If it breaks down, then the technical thinking goes, the dollar is in deep, deep, deep trouble. Of course, it may fall 5, 10, 15 years. It's not just going to collapse from 80 down to 8. It's going to move its way down over and over again. Alright, let's move on and see what's next. Alright, that's the euro up against the Japanese yen. So euro against the Japanese yen, what do you see? Has been fairly stable here from 2003 roughly to 2005. And then you see from 2005 to 2007, what do we see? The euro rising. Probably the better interpretation is that they are against the euro, but that's a different story. In other words, we gotta see when this went up, how did the one move against a basket of commodities? How did the other move against a basket of commodities? And then decide, was this rise due to the euro genuinely rising against all other currencies in the end? Or was it simply because the yen fell against all other currencies? Well, as far as I remember, know and understand, this is actually not that the euro was rising, but the real cause was that the yen was actually falling. We call this in international finance how? Appreciation. No, the yen carry trade causing. In other words, the yen carry trade in 2005 and 2006 has been so intensive that people, borrow in yen, short the yen, sell it, and then they use the proceeds in investment in some other higher yielding currency. So, the yen carry trade, at least short or intermediate term, artificially lowers the value of the currency. That's why Jim Rogers has been telling, well, now is a good time to actually go long the yen because it has been shorted. You have 1 trillion short yen based on the yen carry trade. So sooner or later that yen carry trade must unwind, unwind. In other words, those that shorted yen must buy it back, and that should expect you to the yen to rise. Let's move on. Alright, that's the XJY, that's the Japanese yen index. You can see, here's the trick, you see from 1992 all the way to somewhere mid-2007. That would roughly equate to what? 15 years of a yen price. You now see a very cyclical bull market from 92 all the way to 95. 3 years, that's a nice, just about right length of time for a cyclical bull market. Cyclical is same as primary. Then you see a very nice cyclical bear market from 95 all the way to 98. So that's roughly 4 years. Then you see one correction, a year correction. You can call it a cyclical, you can call it an intermediate correction. But the point, at least the chart tells you, okay, this is how it goes, and sooner or later out of these triangle, you can call it a multi-decade triangle. When the yen breaks out, above or below will be phenomenally significant. So this is the multi-trillion-dollar question. Is it going to break above or break below? And the working hypothesis is that it should be breaking above based on the ultimate unwinding of the carry trade. Well, there has been some unwinding of the carry trade since in the second half of 2007 related to the overall credit crunch, losses on European and American markets, and these losses associated with margin calls on borrowed yen. So people say, oh, you're running losses on your investments, sell out and pay back the yen. Otherwise, whoever lent the yen will be suffering tremendous losses. So there has been already some unwinding of the carry trade. Not a whole lot, but it has propelled the yen a whole lot higher to the point of actually breaking out. So if you're looking here, the yen is in the 92 or 93 range. And remind me next time, or later we're going to see a real-time chart to see if it has actually broken above the 92 or 3 range, or it is still moving inside. Now, while it's still moving inside, that's the technical interpretation. Indecisive. We can't say for sure. We have a working hypothesis, but doesn't mean it's correct. It means this is what I think should happen. Let the chart tell me, is it actually happening or not? Let's move on. Okay, GDX, that's another gold market vectors gold miners index. Again, these guys are trying to see. You see some lows, some highs, again lows, highs. You see from, what is it, 2004 early to mid-2007, 3-year chart. You see the red one here, that's the 200-day moving average. You see how the 200-day moving average made a perfect, absolutely perfect support in here. In other words, it touched and bounced off right away. This here would represent a decent intermediate support. Let's move on. Oh, sorry, one more thing. See, little volumes, and suddenly volumes get to be higher over here. So that's an interpretation that more buying power is coming into the market. Let's move on and see what's next. GDX, well, let's see, August 2007. Again, this is the market taking its time. Now, what you have to understand is that in a classical bull market, but also in a classical bear market, when the market takes its time indecisively, meaning neither up nor down, this is a classical example of consolidation. So, we call this a bull market consolidation. Well, just because we know they were lower here, and at least I know they went up higher later on in 2007, in 2008. Alright, so let's see what's next. Alright, that's the USB, that's the bond. I think we covered this one a couple of times ago. You see a very long term, close to 25-year chart. You see a nice bottom here and here. You see a long-term trend. You see the bond prices going higher and higher. This means that you have a secular trend of lower yields. Remember, when the prices of bonds go up, the yield itself goes down. They're mathematically inverse always. So you see for 20 years, now somewhere in the 82, the short-term interest rates were roughly 20%. Long-term interest rates were roughly 15% back then in 82 when interest rates peaked. And now the 10-year bond is today, please, was 3.9% or so. So they are below 4%. So there may be some more room to grow, but the point is, hey, it's been running for 20 years. For how many more do you expect it to run? For another 20? The point is, sooner or later, and once you have it for 20 plus years, probably sooner, the bull run will be over for bonds. Let's move on. Alright, this is silver relative to Dow Jones Industrial Average. It shows you a price. I'm trying to see, this is 90, so this is 88, 90, 91, 92, all the way to 2004. You see that it forms a base here. You see how these technicians look. Let's move on and see what's next. Alright, this is the US dollar. It zooms in only on the bear part. So, sometimes this is called a triple top. So, you have one top here, a little higher, one top here. Some people say, oh, this is just a head and shoulders. This is the first shoulder, then you have the head, then you have the second shoulder. Fine. What is exactly the technical configuration is not as important. What is important is that you're establishing a secular bear market for the dollar. You see it hits here, the boundary, gets back, hits again, gets back. It seems that this trend here, that is the resistance, seems to be phenomenally strong. So, as long as this is valid, you have your working long-term secular hypothesis untouched. Alright, let's move on and see what else we got. Alright, so you got the gold to silver ratio. What you see here is that gold gains up against silver in value. You see here that silver begins to gain up against gold. That's part of the story, only 7 or 8 years. What anyone who invests in gold and silver knows is that the historic ratio for hundreds, possibly close to thousands of years has been around 15. So, if you have 15, many of the so-called silver bugs are expecting that if the gold-silver ratio is currently 50, well, currently 2007, a year ago it was 50, that silver will dramatically outperform gold during the secular bull market and will return back to its long-term, multi-century ratio of roughly 15. So this gives confidence to those investing in gold and silver that silver will be the better performer. Alright, let's move on. Alright, so this is gold in US dollars. I think we looked at this last time. You see a very, very solid long-term support. Now, first of all, notice that this is roughly how many? 30-year chart. So for 20 years, you have a rock-solid support. You have a resistance here. You have a 20-year secular bear market. So what this guy, Jim Turk, has done is he's shown you a first major resistance level. So number one has indicated. The next way he's seen it, you see resistance, 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 broke above. Then he sees the third level resistance. Do you see this third level resistance? Just flew through it. Then you see the next level resistance. See how the next level resistance from 27 years ago, you have a question? Hold on. 27 years ago, held strong. Well, it went through, it flew away and moved higher. Let's see what the question is.
Is it usually a typical pattern that after you have a double bottom on a graph, you always see a rise afterwards?
Well, that's the definition of a double bottom. If it's a double bottom, it is the reversal pattern. So if it's a double bottom, it is a rise. Otherwise, it is not a double bottom, something else. Alright, question.
I think the chart started from the beginning because I think we've seen these charts already. I mean,
Yeah, we might be, okay, we're starting from this because it's on letter A, so we're moving again, right?
Yeah, but we went to the end.
Alright, so let's close this one. Click on investment charts underneath here. Now click on the updates. You see chart updates. Alright, now double click here, and these are some updates you can see with the dates. Alright, so here is one update. This is what, 2000 and is it 2008, this one? I think it's 2008. You see Dow Jones Industrial Average. Is there a date update? Can you read the date? So here is a very beautiful trend line. Sure, this is remarkably short. This is day by day. See, this is daily data. So within the day, you actually have hourly chart of Dow Jones. And you can see the trend line moves. It moves up. It holds. Again, it holds. You see at least what the interpretation of this guy was, and you can probably read Alien Wave Technology and whatnot. Let's move on and see what's next. The NASDAQ 100, okay, so this is, you can see all the way into 2008, so this is just from a couple of days ago. First of all, you see a very long-term support level here. We're talking from 1992 all the way to last month, or possibly this month, to February of 2008. You see what happened to the NASDAQ 100. So NASDAQ is a very broad index. It's got, well, mostly technology, traded on NASDAQ. So the NASDAQ 100 selects the 100 largest stocks traded on NASDAQ. You see here the bubble clearly. So you see the bubble taking off. And then from here all the way to the top, clearly we call this the blow-off stage of the dot-com telecom bubble. Then you see the first major, and I mean major leg down in the secular bear market up until mid-2002. Then you see a substantial recovery. So from 2002 all the way to 2008, you're seeing a cyclical, 5-year cyclical bull market. The working hypothesis is that you are in a multi-decade, probably 2-decade secular bear market. So you saw the first leg down. This is the cyclical bear market. Then you're seeing the cyclical bull market. And then you're going to see the cyclical bear market taking fresh new lows. That's at least the current technical expectation when you're looking from a secular point of view. So this is, the question is, hey, well, is this short term? It's actually long term or cyclical trend up. When is it going to end and when is it going to break down? So at this point you should be watching 1750 for the dollar NDX. I mean, we can always look it back later in real time to see what happens up until today. Alright, so these are 4 charts. These are very long term. And the first thing to see is that the dollar has broken significantly below 80. You see again how it goes. You see how it goes here. You see that we're in the uptrend, so you might expect major losses on the dollar in the range from 80 roughly down to 60. So you could expect a major leg down, roughly 10, 15 to 20% within the next maybe 1 to 2 years. That will be quite realistic. You wouldn't expect more and you wouldn't expect much less than that. So you see there's some relationship between falling dollar and rising gold. I mean, that's why, what's the purpose? You also see Dow Jones, the trend channels. You also see the SPX, not the S&P 500 index. Again, you see the same stuff. This is what this is telling you. Okay, we have a nice support here, and just recently the SPX has broken. Maybe the guy will now redraw the support to be perfectly parallel to this one. And then watch for this new trend sort of support line to be broken or penetrated from underneath. Again, different interpretations. Let's move on and see what's next. Oh, no, that's previous. Next image. Okay, next again. Let's try next again. Alright, so this is gold. Let's see what we have here. Oh, this is only to September of 2007, I would guess. Yes, 28th of September 2007. You see gold is beginning its rise here at 650. You can see all the way to 750. That's, oops, just barely 1 month, a month and a half. Gold is making a nice, what is it, $100 move in just 1 month. Well, that's a fairly nice return if you get to think about it. It's what, like 15% return in a month? Well, that's not a bad return, right? Now gold is 920, so from 750 you can see it's even better return. Let's move on. Okay, so this is gold. This goes to, oh, this is a fairly long-term chart of gold. Update here is that, oh, this is what this guy was looking at. This guy was looking at 730 and say, okay, this is a major resistance. Is gold going to break above or not? Or is it going to start to linger back and consolidate some more before breaking on its way up? Let's click next, see what happens. Again, see how the thinking goes about silver. That's the triangle, that's the other one. It broke once. This is September 2007, that's 4 months ago. Now we know from 14 went to 16, went to 17. Let's move on and see what happens. This is gold, continuous contract. Again, same stuff. Let's move on to the next. This is the GDX. You see, this is, okay, so remember when I was showing previously this chart, once, twice, 3, 4 times has been tested. So the first time and 3 times tested couldn't go through. So what this guy is saying here, oh, check out gold stocks. They actually penetrated above. In other words, they're breaking out on the upside. And if they're breaking out on the upside in a fairly, let's say, 15-month resistance, this has got to be very significant. So, one of the important lessons is the longer a support or resistance holds, when it penetrates above or below it, the more significant the move. So for a technician, this is extremely significant move. It simply says, oh, in September 2007, we're poised from here to a major ride to the sky, right? We're all going to get rich from gold, right? All right, let's move on. All right, so gold price, you see the same stuff, up to 1,000. Again, this is a longer term. This has been updated. I don't see the date here. Okay, the date is up there. This is, if you zoom in up there, 2008, February 1st. So on February, no, you don't have to zoom in. That was for the camera. So February 1st means roughly, 16 days ago. You see that gold broke out of here and it moved to close to the 1,000 area. Actually it reached close to $940. It has corrected back to 920. But the point is that it has moved its way up. You also see this long-term trend. Long-term meaning valid from roughly 1999. This is good 9 years so far. Let's move further and see what's next. This is spot New York silver. Remember what happened? There was one triangle here, consolidation. We've seen before a second triangle consolidation. And what this guy is saying, hey, around late 2007, early 2008, silver made a major breakout. So for a technician, again, this move on silver is phenomenally significant, especially because the triangle has been formed from late 2005 to all the way of 2008. So this is roughly a 2-year consolidation. So in a secular bear market, you get here a 2-year consolidation, and then silver more or less doubles. Now you have another 2-year consolidation. So the guesstimate, of course we don't No, we call it in technical terms, it's called a price target. So the price target is roughly to almost double, You look here from roughly $6 all the way to $7, all the way to 14. So now you're looking here, once it breaks out, to go all the way to roughly $25, $30. So we call the expectation of the price to reach before the next consolidation, we call it a price target. So the price target is 25, 30, at least I've heard half a dozen or a dozen technicians say, okay, well, that's our price target. Well, now, beginning of 2008. Now, the other thing to be very important to understand, let's illustrate, is from your exam that you're supposed to submit to me today, is that most of the time, the bull market is doing nothing. What does it mean? It means that very small percentage of the time the bull market runs fast. Here, the bull market sees not doing much or anything. Suddenly, it runs up for about 5 months, and for 2 years, silver does nothing, meaning no gains. Then you get here in early 2005, silver skyrockets and doubles in roughly 6 months, and then for 2 years it does nothing. This is one of the most important properties of both bull and bear markets, is that major move in the direction of the market, meaning in a secular bull markets, major moves in the direction of the bull market are always very short in time and very explosive in moves. Again, same thing applies to the dollar on the way down. When the dollar falls, it falls precipitously in 2 or 3 months. Major losses, and then 6, 8, 10 months does nothing. It can consolidate for 2 years. And then when it gets to fall, in 3, 4, 5 months, it's going to lose an awful lot. And then a year, almost nothing. So, that's one of the most important things to remember about both bull and bear markets, is that the major move in the direction of the market will be no more than 15% of the time. So, you would expect 70% of the time the market to do nothing, and still, when it gets to do something, it will do it real fast and in a surprising manner. Alright, let's move on and see what happens next. Alright, that's zooming into the same chart for gold. Again, you see one triangle. You see, again, similar example with gold. Once gold reached the 325 or 350 level 2002, gold did literally nothing to 2005. For 3 years, gold did nothing. And then it more than doubled, okay? Then from here, for a year and a half, gold did nothing again. It actually lost. But from here, from 500, gold exploded all the way to 940 so far. Now, from 940, it may consolidate, or it may go to break above 1,000 and beyond. Again, I can't really tell. I'm betting on it. At least I bet, what is it, yesterday, right? Yesterday, so I was talking about that little gold coin that I bought yesterday. This is called lower demand for money. What does it mean to lower demand for money? What does it mean? Is your demand for money low or high? Oh, it's relatively high. Let's say you're getting 1,000 today, you could get 3,000, would be much better, right? Yeah, well, okay, guys, I was having this discussion today with introductory macro. Well, the kids just want millions. They're not going to be happy with a couple of thousand, so that's the introductory macro course. Demand for money means you must sell something, you must sacrifice something else in value, whether it's your own work, your house, your shoes, or whatever asset you have. You gotta sell something, or if you're a business, you produce shoes and then you sell these shoes. And by selling goods and services, You demand money, all right? So that's the demand for money. Why demand for money might fall? Because of inflationary expectations. You expect money to lose value 20% this year, you'd better lower your holdings because whatever you hold for, this year, you're going to lose money for 20%. So, again, don't mistake with wishing or wanting to have a lot of money with actually demanding money, meaning sacrificing something of real value, including labor and work, in order to get money, which you'll be spending at a later time. So, during inflationary times, the typical pattern is that demand for money falls. When demand for money falls, do prices fall or rise? Rise. When people's demand for money falls, when my demand for money falls, I'm trying to get rid of my money. The university just deposited my paycheck, so I don't want to keep thousands level balance. I just want to go right ahead and spend it. And, well, I don't want to actually consume it either, so I spend it by converting it to some harder asset than a piece of paper with a president on its face. Alright, so, again, gold does nothing, it lingers, it doubles, let's move on. Oh, CRB. CRB is, of course, one of the most important indexes that you would get. CRB is the Commodity Research Bureau Index. I was explaining this last time. It contains 15 commodities, at least back before the government started fiddling in manipulating the index. Each commodity had equal weight to the other. It had decent chunk of agricultural commodities, wheat, etc., corn. So, what you see here is long-term. This is actually a secular analysis. Commodities didn't do much from late or mid-50s all the way to the 70s. You see, commodities didn't do much or anything. Then in the 70s, you see the explosive move of commodities up. Well, commodities didn't go up in value, of course. A wheat, bushel of wheat 30 years ago has got pretty much the same value as a bushel of wheat 29 years ago as it has today. The nutritional value hasn't changed much, and the human stomach hasn't changed as a biological species. You haven't changed much. What really happened here was the measuring stick, the yardstick against which wheat and other commodities were measured, just collapsed. So, it's not that commodities skyrocketed in value. It is the price in which they were measured doubled. It simply means that the currency collapsed in value correspondingly. Of course, when it collapses in value, of course, the purchasing power of stock, bonds, and any other financial asset. So, if you invested in commodities back then, you would have made a ton of money. But the point is, it's one explosive move, then nothing happens for 40 years. Again, a second phenomenal explosive move, prices quadruple roughly for commodities. For gold and silver and all went up way, way, way more than that. And then you see the 20-year bear market again. Now, what do we see here on the CRB? Again, bottoming roughly in 2000. Then you see an explosive move on the way up. You see it's been running 5 years. So, what I would expect personally at this point is that, this explosive move from 50 all the way to 400 or 500 should mean that we're going to get for 2 or 3 years a major cyclical correction in commodities. In other words, the commodity bull market, which is expected for the next 10-15 years, in other words, a 20 years secular bull market, this has been going too far for too long. So I would expect 2, 3, 4 years, similar to what happened in 1973, before the next major leg up. Of course, that's me. What's the word in English? What's the correct word in English? Speculating. So that's me speculating. You know what's to speculate? Means to think about the future, to try to forecast the future. So it's me speculating, that's my intelligent guess. We gotta get a decent pullback, or no pullback here. 3-4 years churning and doing nothing. It is called, what's from the exam, how was it called? How is this called? How would Richard Russell call it?
Consolidation.
Yes, we call it consolidation, but what's the meaning? What's the interpretation? It tries to wear out or tire the bulls and tire them of waiting, and those that are investing in commodity here, they will wait a year, no profit. Second year, no profit. Third year, no profit. And the bulls get tired and restless. They dump the whole thing, meaning the weak of the bulls will get rid of their positions and the commodities will shift to strong hands. And once those bulls, well, meaning a big percentage of them, give up on the commodity bull market, okay, bull market is over, as of course many declared in 76 to be over, and then it's going to be the next explosive move on the way up. So that's very important to read the sentiment, all right? So now the sentiment of commodities is phenomenally bullish. It has lost momentum over the last 2 months. For what reason? Expectations of a US recession, expectations of a possibly UK recession, expectation of a major slowdown for Europe. So suddenly everyone is expecting a global slowdown, and the thinking goes, oh, this gotta be terrible for commodities. So commodities correct and pull back, all right? Well, when you get that kind of correction, it means that there is likely yet another leg on the way up, all right? So again, we may see in the next couple of months another major leg up before 2, 3, 4 years you get the churn. Of course, it could be a year up, but sooner or later you gotta have 2 or 3 years of a consolidation to wear out the bulls. All right, let's see. Silver about to pop big time. So again, this is up to October 2008. You see this guy has drawn the chart. You've seen a major breakout above this resistance level. See, the resistance level has been in force since February 05 and has been in force up until September. It's got to be 06 or so. What is it? What is this chart here? February 04, March 05, April 02, May, June, July. This chart is messed up here. See, 05, 05, 02, 07, 04, 02, 06. So the chart is messed up. But the point is, nevertheless, that's got to be September 07. There is a breakout. So the 13 has been, this trend here has been penetrated. So silver is expected to go, again, sky high. We're going to be becoming rich out of silver. Let's move on and see. All right, so this is a very interesting chart. It's coming out of the Elliott Wave International. Its guy is one of the most prominent technicians in the world. He's called Robert Prechter. He's mostly into Elliott Wave theory. He's currently the leading scholar of Elliott Wave theory. But the point he's trying to make here is, check this out, from 1929 all the way to the bottom of the Dow Jones bear market, 1932. You see the nice pattern and the percentages on the way down and whatnot. Let's see if it's up to 32. I don't see the date. Yes, 1929 to 1932. Now, if you take a look from Japan's Nikkei from 1989 to 2002, notice the scaling. Up here, you have a scale of a total of 4 years, roughly. 29, 32, roughly 3-4 years. Over here, the scaling is 89, 2002. We're talking roughly 13 years. So this type of a bull or bear market is like 4 times longer in time. So the scaling is 4 to 1. And you see that if you get to look, you'll see the parallel here and here. Again, you should be able to see with pure inspection by eye, no econometrics necessary, all right, that these are actually highly, what's the econometric term, how we call it?
Correlated.
Correlated. Well, if it's with time, we call it co-integrated. So they are co-integrated. So correlated is the weaker term. Co-integration is because the co-integration now is also scaled and whatnot. All right. So what do we have here? What is his hypothesis? His hypothesis is that this is a classical pattern of a bear market. You see the 2000 peak. You see now going down. Nasdaq fell. So what you see here is what's going on, and here is Bernanke versus the S&P. So what he's showing you, hey, this is where Bernanke took over, this is where it's down. Again, you will have to take your time to inspect it very carefully. Sometimes it should take you 5 or 10 minutes and just stare at it to get to understand it. Let's see what's next. Dow Jones Industrial, we did this chart, right? So this is where we started, all right? So we're done with this. How much time we got? 10 minutes. The guys want to go, and next time we'll continue. First of all, let's see if you guys have some questions. So next time we will finish off technical analysis. The game plan continues with we'll get to stock charts and try to pull up some of the major charts, meaning bonds, stocks, gold, dollar, what else? The Nikkei, the yen. So we're going to get some of these charts and see what happened, what's the interpretation. When we pull them up, we're going to be seeing them up to the date, real time, up to the same day. We'll see what happened to which of them and how it happened. So, any questions? No questions? None. Alright guys, so, alright, well, 10 minutes early, let's go home and you guys enjoy your weekend. Alright, let's pause it.